Hi everyone, welcome back. Now let's start with the topic convertible bonds, which is one of the most frequently tested areas in CA final examination. Convertible bonds basically represents bonds where an investor has a conversion option. All right, a bond where investor can actually convert his bond into equity shares. All right, it is presumed that bonds are getting converted into equity shares. An investor has purchased a bond, and at the time of purchase itself, he's aware that there is a conversion option where this bond can actually get converted into equity shares of the same company. Convertible bonds can actually be of two types. There can be compulsorily convertible bonds or optionally convertible bonds. Compulsorily convertible is where the investor does not have an option. All right. For example, I am purchasing a bond which has a maturity of 5 years. At the end of fifth year, whether the investor wants to convert or not, the bonds will automatically get converted into equity shares. Those are called as compulsorily convertible bonds. The other is optionally convertible, where at the end of fifth year, investor is given a choice as to whether he wants to redeem his bond for face value or redemption value, or whether he wants to convert the bond into equity shares. The investor is basically given a choice to either receive money in the form of redemption value or actually surrender the bond and convert it into equity shares. In case of compulsorily convertible bond, the intrinsic value of a bond, we calculated the intrinsic value of a normal bond as the present value of the future cash flows that we are expecting to receive. The present value of the future cash flows that we are expecting to receive, that is how we calculated the intrinsic value of a normal bond. In case of intrinsic value of a compulsorily convertible bond, intrinsic value is going to be calculated as the present value of coupons plus the present value of the equity share value that is expected to be received after the maturity of the bond. In the example that I gave, at the end of fifth year, the bond is going to compulsorily get converted into equity shares. Let us say I'm standing at year zero, which is today. 5 years later, the bond will be getting converted into equity shares. For the next 5 years, I will receive coupon. At the end of fifth year, I'm not going to have any redemption value. The bond is going to get converted into equity shares. So how do I calculate the intrinsic value today? Intrinsic value will be calculated as the present value of the next 5 years coupon plus the expected share price will then be discounted by 5 years. The expected share price at the end of fifth year should also be discounted into today's terms, and the sum total will actually be equal to the intrinsic value of the bond. Obviously, it's going to be a challenge for you to forecast the expected share price at the end of fifth year. Is it very easy for you to forecast the share price at the end of fifth year? The answer is no. It is going to be a tricky task, and therefore intrinsic valuation of compulsorily convertible bonds is actually tricky. But what I'm trying to drive home over here is, instead of discounting the redemption value, which you will receive at the end of fifth year, in case of a compulsorily convertible bond, you will be discounting the expected share price. The expected equity value is going to be discounted. Now, if the company is performing well, if the company is performing well, the expected share price at the end of fifth year is going to rise. All right. If the company's results are doing great, the expected share price at the end of fifth year will actually increase, and that is going to increase the intrinsic value of this bond. All right. Therefore, as time passes by, if the company's share price is doing well, the intrinsic value of the compulsorily convertible bond also increases. But if the company's share price is not doing well, the share price is actually falling, then the intrinsic value of this bond also will keep falling. All right, the intrinsic value of the bond over here is a function of the share price itself, that is going to prevail at the end of fifth year. Let's look at it via an example. Let us say the coupon is 10% and YTM is also 10%. Face value is 1000, maturity is 3 years. At the end of third year, I'm stating that the investor is going to receive 20 equity shares. At the end of third year, investor is going to receive 20 equity shares for every bond. All right, investor is going to receive 20 shares for each bond. The market price of the share today is rupees 30. This is the market price of the share today. The expected market price of the share after 3 years is rupees 70. After 3 years, I expect the share price to be rupees 70. How do we calculate the intrinsic value of this bond? Intrinsic value of the bond will be the present value of the coupons for the next 3 years plus the present value of the equity shares, the present value of the equity shares that is going to prevail at the end of the third year. So the share price that is going to prevail at the end of third year is 70 rupees. I am going to receive 20 shares for every bond. Therefore, the equity value is going to be 70 multiplied by 20, which is equal to 1400. All right, 1400 is the expected share value at the end of third year. Remember, you should not be taking only rupees 70 at the end of third year, because for every bond, you're receiving 20 shares. Therefore, the equity value at the end of third year should be 70 multiplied by 20, that is equal to 1400. All right, so the intrinsic value will be calculated as the present value of 100, 100, 100 that you're receiving for the first 3 years plus 1400 that you're receiving at the end of third year. You will discount it at the YTM rate of 10% to get the discounted cash flow of 1300.47. All right, this is the intrinsic value of the compulsorily convertible bond. I'll take a pause to check if you have any questions.
All good.
All right. Now comes the second type of a convertible bond, which is optionally convertible bond. In case of an optionally convertible bond, an investor is basically given an option to convert into equity shares. He's right now the holder of a bond. He's not going to mandatorily get converted as an equity shareholder. He's given a choice to either continue holding the bond and receive the redemption value, or to actually convert the bond into equity shares. All right, he's got an option to either convert it into equity shares or not to convert it into equity shares. That is in case of optionally convertible bond. Now, if you carefully think of it, in case of intrinsic value of a compulsorily convertible bond, I actually mentioned that we will be taking the present value of equity shares at the end of the maturity. What we actually did in this example is that we took 1400 as year 3 value, and we discounted it. But in case of optionally convertible bond, we do not know whether the investor is going to convert it into equity shares or whether the investor is going to choose to receive the redemption value. We do not know whether the investor is going to convert it into equity shares or whether he's actually going to receive the redemption value. Therefore, this amount of cash flow is not determinable with certainty. Over here, we knew that the investor does not have a choice. In case of compulsorily convertible bond, we knew that the investor does not have a choice to receive the redemption value. Whatever is the share price, he will actually receive 20 shares of it. Whether the share price is 1 rupee or whether the share price is 70 rupees, he is going to receive 20 equity shares. And what we actually did is we took the expected share price as a cash flow at the end of year 3. But in case of an optionally convertible bond, the investor has a choice. If the share is actually doing well, he will actually get it converted into equity shares. But if the share is underperforming, he will not get it converted into equity shares, and instead he will actually choose to receive the redemption value. All right, so the year 3 ultimate cash flow is actually a variable. It's not known, but it's actually a variable. All right, so that is the reason intrinsic value of an optionally convertible bond is not the same as that of a compulsorily convertible bond. Now, how do we calculate the intrinsic value of an optionally convertible bond? The intrinsic value of optionally convertible bond is broken down into two parts. One is we actually value the bond assuming that there is no conversion. Assume that there is no conversion option. Just value a bond as if it is a normal bond, as if it is a regular bond where you'll have coupon for 3 years plus maturity value at the end of third year. You'll have coupon for 3 years plus maturity value of the third year. That is referred to as intrinsic value of a bond assuming no conversion. This is also known as straight value of a bond. This is also known as straight value of a bond. In addition to this, now the investor over here has an option to convert it into equity shares. He will convert it into equity shares if the share price is rising. If the company is doing well and the share price is rising, he will convert it into equity shares. But if the share price is falling, he will not convert it into equity shares. Therefore, clearly, this option is actually a benefit to the investor. Option in case of a compulsorily convertible bond, whether the share price was rising or falling, the investor was mandatorily forced to convert it into equity shares, whereas over here he's actually got an option. All right, that option is actually a benefit to the investor, and that option is going to have a separate value in itself. All right, that option is actually going to have a separate value in itself, and that value of the option is what we add to the intrinsic value of the bond, assuming no conversion. All right, we're going to start with intrinsic value of a bond, assuming no conversion, or straight value of a bond. To that we add the value of the option. This option, which is a benefit, is also going to be separately valued, and that value is going to get added to the straight value of a bond to calculate the intrinsic value of an optionally convertible bond. All right, so how do we calculate the intrinsic value of an optionally convertible bond? We start with the straight value of a bond, and then we add the value of the option. The ability to convert it into equity shares, if the share price is rising, is going to be valued separately, and that value is going to get added to the straight value of the bond, and this is how we will actually arrive at intrinsic value of the optionally convertible bond. All right, in fact, valuation of options is a separate chapter. You actually have option valuation as a separate chapter in CA final curriculum, where we will actually see how this option contracts are valued. It is outside the scope of this particular chapter, but you actually have a separate chapter where you will see how to value options. All right, ICI has not touched upon how to value options in this chapter. It's there in a separate chapter, and it's actually not even shown how to value the bond. This equation also, whatever I've given over here, is actually not given in the ICI curriculum, but I'm only covering it for the context of how an intrinsic value of an optionally convertible bond is calculated. All right, so the formula is also not really there in the curriculum, so you don't need to really worry about it. But at least if you have a thought on how this option is going to get valued, then don't worry, there is a separate chapter where we are actually going to look at it. But one thing that you would have to remember is, if the equity share price is actually rising, if the equity share price is rising, then what will happen is this option is going to rise in value. This option is actually going to rise in value. The value of that right is actually going to increase. The right to convert it into equity shares is going to increase with the share price increase, and therefore if this increases, the intrinsic value of the optionally convertible bond also increases. If the equity share price is decreasing, then this option contract value is going to go down. It will go down to zero if the equity price crashes, and therefore if it goes down to zero, the intrinsic value of the optionally convertible bond will be exactly equal to the straight value of a bond. All right, if the equity share price crashes down to zero, let us assume that the company is doing really bad. Let's not assume zero, but the company is doing very bad and the equity share price crashes. If equity share price crashes, this option value will actually have an option of zero. The value will actually be equal to zero of this option. Then in such a case, the intrinsic value of the optionally convertible bond will be exactly equal to the straight value of a bond. And hence, I wrote a statement which is the straight value of the bond is also referred to as the minimum value of the bond. The bond's value cannot be lesser than this value, because remember, option contract is only a benefit for you. It can never result in a loss for you. The option contract is only a benefit. You either convert it into equity shares or you receive the redemption value. It's never going to result in a loss for you. Therefore, the value of the option is always going to be greater than or equal to zero. The value of the option will always be greater than or equal to zero. If it is equal to zero, then the intrinsic value of the optionally convertible bond will actually be equal to the straight value of the bond itself. All right, therefore, if equity share price reduces, then the value of option will fall, and the intrinsic value of the optionally convertible bond will be equal to the straight value of the bond. I'll take a pause to check if you have any questions. Yes, there might be some ambiguity with regard to valuation of the option and how and why I wrote that it's going to be greater than or equal to zero, but all of that we're going to discuss it in a separate context itself. Any
All
questions?
good so far.
Okay. All right. Now let's move on to conversion date. In case of a compulsorily convertible bond, the maturity date is always going to be equal to the conversion date. The conversion date will actually be on the maturity date. We had a maturity of 3 years. At the end of third year, it is going to be compulsorily converted into equity shares. Therefore, the conversion date is equal to the maturity date. What is going to happen is the investor is going to give his bond and receive 20 equity shares. In our example, we're actually going to receive 20 equity shares for every bond. In case of optionally convertible bond, conversion date can either be on the maturity date or it can be any date before the maturity date itself. Let us say the bond had a maturity of 3 years. At the end of third year, the investor will be given an option to either receive the redemption value or receive equity shares. This is a case where the conversion date is on the maturity date. Alternatively, what can happen is the bond has a maturity of 3 years. The investor has a conversion option at the end of second year itself. The investor has got an option at the end of second year itself to either continue holding the bond or to immediately convert it into equity shares. The investor has a choice to either right now convert it into equity shares, or he may continue to hold the bond for a period of 1 year, and at the end of third year he will then receive coupon and maturity value for year 3. All right, so if the conversion date is before the maturity date, let us say at the end of year 2, the investor has to choose either continuing to hold the bond up to the third year or to convert it into equity shares immediately. All right, if the conversion option is on maturity date, he has to choose between receiving redemption value versus receiving equity shares. Whereas if the conversion date is before the maturity date, then he has to choose between receiving equity shares immediately or continuing to hold the bond for one more year, and then he will receive the coupon and maturity value at the end of year 3. All right, so he has to, the choices that he has to make are going to be different in case the conversion date is before the maturity date versus the conversion date being on the maturity date. All right, so if the conversion date is equal to the maturity date, which is case 1, what is going to happen is he will receive cash if he doesn't convert, or alternatively he can surrender the bond and receive equity shares. If let us say the conversion date is before maturity date, that is case 2, conversion date is on year 2, maturity date is year 3. What will happen is if he converts, then he will surrender the bond and receive equity shares immediately. If he doesn't convert, then he will continue to hold the bond. He will continue to hold the bond for one more year, and he will receive interest for year 3 and maturity value for year 3. All right, he will receive interest for year 3 and maturity value at the end of year 3. Obviously, if he converts into equity shares at the end of year 2, he is not going to receive interest for year 3, and he will also not receive maturity value at the end of year 3. So if he converts before, if the conversion date is before, then he will receive equity shares and not receive interest and redemption value if he chooses to convert. All right, so that is going to be the difference between conversion date being on maturity date and before maturity date. I'll take a pause to check if there are any questions again.
All good. I just have a separate question. So, for example, if we are taking compulsory convertible bonds for equity, we have an estimate of what the price will be of the equity share at the end of 3 years, which is maturity.
Right.
So the estimate will change each year for the present value of equity shares, right? At the end of that, we are going to receive the amount
It
of
will keep
equity
changing
shares.
every moment as equity share price changes.
Okay, okay. So we'll continue to reevaluate in the
Correct. Therefore, intrinsic value of the bond will actually keep fluctuating. And that is the case even for a normal bond. Intrinsic value of any bond is not going to remain constant, right? Based on changes in market, intrinsic value will keep changing. And the same is the case with case of compulsorily convertible bond. The only difference is compulsorily convertible bonds intrinsic value will change or fluctuate more wildly than a normal bond. Reason why it's going to fluctuate more wildly is because the year 3 number, which is equity share driven, is going to fluctuate. Equity share price will keep fluctuating, and that is going to result in a fluctuation in the intrinsic value of the compulsorily convertible bond.
Okay, got it.
All right. Okay. Now let us actually assume that we are standing on the conversion date, and we are also presuming that this conversion date is the maturity date. All right. In my example, 3 years, third year is the maturity date, and third year is also the conversion date. Let us assume that this is an optionally convertible bond. Now the question is, when will the investor opt for conversion? All right. So I am standing at the end of third year. When will I actually choose to convert? It's going to be very simple, right? If I don't convert, I'm going to receive a redemption value of 1000. If I don't convert, I will be receiving a redemption value of 1000. If I convert, I will be receiving 20 equity shares, let us say of X share price, 20 equity shares of X share price. And this X is basically the current market price of the share. All right. If I convert, I will be receiving 20 multiplied by x. The amount of benefit that or value that I'm going to receive is 20 multiplied by x, right? If 20 multiplied by x is greater than 1000, then I will basically convert my bond into equity shares. If 20 multiplied by x is less than 1000, I will not convert. All right. I've got two options with me, one of receiving 1000 rupees, the other receiving 20 shares. All I'm going to do is to evaluate whether I should be converting or I should not be converting. I will be comparing this 20 shares value with rupees 1000. If the 20 shares value, which is 20 multiplied by the current market price, if that is greater than the redemption value of 1000, I convert. Otherwise, I will not convert. All right. That's a very simple decision to make if the conversion date is the same as maturity date. If the conversion date is the same as maturity date, I will be receiving either rupees 1000 or 20 shares. I compare their value, whichever is more beneficial, I will go with that option. All right. Now the value of equity shares, which is 20 multiplied by x, that is referred to as conversion value. That is referred to as conversion value. 20 multiplied by the current market price is referred to as conversion value. Therefore, if the conversion value is greater than maturity value, then I will actually opt for conversion. If the conversion value is greater than redemption value or maturity value, I will be opting for conversion. If it is less than maturity value, then I will not opt for conversion. Deciding whether to convert or not convert is a very easy decision to make if the conversion date is the same as maturity date. Reason being, you will be receiving maturity value also now, and if you convert, you will also receive the conversion value now. So it is easy for you to compare because both of them are standing at the same point in time. Whereas if conversion date is before the maturity date, if conversion date is before maturity date, your conversion value is standing at year 2 versus you actually have to compare with the maturity value at year 3, and therefore it might actually be a slightly trickier comparison. Let us actually look at it with a few questions. Let us do a question with regards to when an investor is going to opt for conversion and when he is not going to opt for conversion. Okay, let's look at problem number 20. Rural Electrification Corporation Limited has issued 1,000 optionally convertible debentures of 10 years at a coupon rate of 10%, which is convertible to 50 equity shares on a date exactly 5 years before its maturity. All right, is this a case where conversion date is on the maturity date, or is it a case where conversion date is before the maturity date?
Before, because the rate is actually 10 years, the maturity
Right. So this is a 10-year bond, but we actually have the conversion option 5 years before the maturity. So 5 years have passed by, and now we have an option to convert it before its maturity itself. The date for optional conversion has come, which means we are now standing at the end of fifth year. All right, we're standing at the end of fifth year, and I now have to decide whether I want to convert it into equity shares or whether I want to continue holding the bond. The shares are quoting at rupees 25. The shares are currently quoting at rupees 25. Investors expect 8% per annum return on 5-year debenture. Investors are actually expecting 8% per annum return on a 5-year debenture. The question is, will you suggest the conversion or will you not suggest the conversion? So what we are basically going to do is, if we convert it into equity shares, we will be receiving 50 equity shares today, whose whose price is 25. The shares, 50 equity shares whose price is equal to 25. So the equity value or conversion value is going to be 1250. All right, 50 equity shares I will receive. Each equity share is rupees 25. So if I sell the shares immediately in the market, I am actually going to receive 1250 rupees as cash. All right, so I will surrender the bond, receive 50 equity shares, sell those 50 equity shares, and I will actually earn rupees 1250. I will be selling them at rupees 25. That is when I actually sell the equity shares, or if I convert the bond into equity shares. If I don't convert the bond, what I'm actually going to do is I'm going to receive coupon for the next 5 years, and I will be receiving redemption value at the end of fifth year. Remember, the bond was issued for a period of 10 years. 5 years have actually passed by, and therefore what is left is 5 years of coupon and redemption value, which is going to be received 5 years from today. All right, the redemption value is going to be received in 5 years from today. I can calculate the present value of the coupon and the maturity value, the present value of the coupon and maturity value, I will be calculating it into today's terms. That is basically the value of the bond. The value of the bond is basically the present value of the remaining 5 years coupon and the maturity value that I will be receiving at the end of 5th year from today. I will then compare it with 1250. 1250 is the value of equity. This is the value that I'm going to receive if I convert. If I do not convert, I'm going to receive coupon and maturity value. The present value of the coupon and maturity value is what I will calculate. All right. I'm not getting into the calculations because we have seen umpteen number of calculations of value of a bond, but the value of the bond will be 1079. All right. So if I convert it into equity shares, the value is 1250. If I do not convert it and if I continue to hold the bond, then I am actually going to receive 1079 in present value terms. All right. I could not do a straight comparison because 1250 is in today's terms, while coupon and redemption value are in future terms. Therefore, I first discount it and then I'm actually doing a comparison. All right. So if I convert it into equity 1250, if I continue to hold the bond, the present value of the benefit that I expect to receive is 1079. Therefore, what am I supposed to do in this case?
I'm supposed to convert.
So therefore, I will actually opt for conversion. I will opt for conversion because the benefit of converting into equity shares is greater than the benefit of continuing to hold the bond. Any question?
No, all good.
All right. Let's look at problem 21. Sri Renuka Sugars has issued convertible debentures with a coupon rate of 12%. Each debenture has an option to convert into 20 equity shares at any time until the date of maturity. Now, if you look at it, this conversion date is not a particular point in time. It is actually a period. All right. And an investor has an option to convert one bond into 20 equity shares any time until its maturity. All right. So this is a conversion period. Let us say if the bond has a maturity of 5 years, if the bond has a maturity of 5 years, at any point over the next 5 years, I can choose to convert. I can choose to convert today, or I can choose to convert 2 years later, 3 years later, or so on. All right, this is referred to as a conversion period. In all the examples that I was referring to earlier, I assume that there is one particular conversion date. You have to convert today, or otherwise you don't have the option. Over here, the question is saying that we have an option to convert it into 20 equity shares until the date of maturity. So this is a conversion period. Not that this is going to change the way we are going to approach the question, but I thought it's worth clarifying that this is not a conversion date, but it's a conversion period. Debentures will be redeemed at rupees 100 on maturity of 5 years. An investor generally requires a rate of return of 8% on a 5-year security. Now the question is, as an investor, when will you exercise conversion, assuming the current market price of equity share is, there are three cases given, 4, 5 and 6. All right, the question is, will you exercise the conversion if the current price is 4, if the current price is 5 and if the current price is 6? All right, let us actually let us actually do the solution. I don't want to actually rush through it. Let's actually do problem number 21. If I don't opt for conversion, let us say I'm not opting for conversion, I will actually receive coupon for the next 5 years and I will receive face value or maturity value of rupees 100. All right. So I will have years 1, 2, 3, 4, and 5. I actually have coupon. Coupon was 12%. So the coupon is going to be 12, 12, 12, 12, and 112. I then have present value factor. The required rate of return was given as 8%. So I take the present value factor at 8% and then I have discounted cash flows. Could you please quickly help me with what the present value factor is?
0.925,
Okay.
0.8573,
I think it's 0.92659. Okay. Point. Next.
0.8573,
Next.
0.7938,
Okay.
0.7350,
Okay. The last is
0.6805.
0.6806 I'll take. All right. And the discounted cash flows. Can you quickly tell me the sum total instead of me writing each discounted cash flow? Okay, so this discounted cash flow is going to be 115.97. So if I don't convert the bond, the present value of the benefit that I expect to receive is 115.97. The benefit that I expect to receive is 115.97. Now, the question is given that assume that case 1, the equity share price value is rupees 4. If I convert it, I am going to receive 20 equity shares. 20 equity shares whose market price is 4 rupees. Therefore, the value is going to be 80. All right. So if I convert, it's going to be 80. If I don't convert, it's going to be 115.97. So what am I actually going to do in this case?
You won't convert.
Right. So under case 1, it's going to be 20 multiplied by 4 versus 115.97, right? Which is equal to 80 versus 115.97. Therefore, I will not convert. I will continue to hold the bond for the next 5 years and I will actually receive redemption value at the end of 5th year. Under case 2, they gave that the value of the equity share was 5 rupees. So it will be 100 versus 115.97. What am I going to do in this case?
I'm still going to hold.
Still don't convert and hold the bond. In case 3, they gave that the equity share price is actually equal to 6. That is equal to 120 versus 115.97. What am I going to do in this case?
I'm going to convert.
I will be converting because the benefit that I'm receiving from equity shares upon conversion is actually greater than the benefit that I'm going to receive upon continuing to hold the bond. But this is a determination that we are doing today. Okay, but remember in this case, the conversion date was not a point in time, but it is actually a period. And therefore, the comparison that we just did is basically assuming that the share price today is rupees 4. See, let us assume that the share price today is rupees 4 and we decided that we will not convert the bond. But is the share price going to remain 4 through the entire 5 years? The answer is no. Share price will keep fluctuating and therefore you actually have to re-evaluate as share price keeps changing. Assuming that it is rupees 4 today we will actually not convert. We're not going to convert today, but there can be a point in time when this 4 rupees actually increases. Let us say if it increases to rupees 10 after 1 year, then after 1 year we are again going to require to do this comparison, and at that point in time we may actually choose to convert. All right, so if the conversion date is a period, this determination will have to be done at every point in time whenever the share price changes. You compare the share value with the value that you expect to receive by continuing to hold the bond. Whichever is more beneficial, you will opt for that option.